Okay, so we've been given information about the company here. All right. The revenue, cost of sales, profit before interest and tax, the profits, dividends payable, our long-term debt, current assets, current liabilities, receivables, payables, and inventory. Okay, we've been given all this information here, and we have to analyze for this company. Okay, we have to use the various ratios so that we can analyze the performance of this company. Okay, so we're going to start with the easiest of all of them, the profitability ratios. Okay, profitability is how well a company generates its profits. Okay, yes. So we look at we've been given information for the years 2022 and 2021. So we're going to be comparing. Okay. So the first profitability ratio we use gross profit margin. Okay, gross profit margin, it just tells us out of our revenue, what percentage is gross profit. All right, that's in the percentage form. In decimal forms, out of every one quarter we make in sales, what is our gross profit? Okay, so this is the formula for the gross profit margin. It's your gross profit over your sales revenue. Now, in this question, they never gave us our gross profit. Okay, so you have to remember gross profit is sales revenue minus cost of goods sold. Okay, or cost of sales. So we come to our balance, our financial statement here to get our gross profit. It's our revenue minus cost of sales. Okay, that will give us our gross profit. All right. So we're going to compare for each. We'll start with 2022, then 2021. Okay, so for 2022, the sales revenue is 74,521,000. The cost of sales is 28,256,000. All right, so we divide that by sales revenue. So when we subtract the sales revenue minus cost of sales, we find a gross profit of 46,265,000 kwacha. So when we divide 46,265,000 kwacha divided by 74,521,000 kwacha, we get 0.621. Okay, 0.621. So this 0.621, as I said, with these ratios, you can interpret them as decimals or as percentages. So if you want to interpret this as a decimal, this 0.621 means for every one kwacha we make in sales, 61 ngwe is gross profit. Okay. If you want to convert it into a percentage, you just multiply it by 162.1%. So if we're interpreting it in percentage form, okay, from our sales revenue, this 74,521,000, 62.1% is gross profit. Okay, 62.1% of the sales revenue is gross profit. Any questions? Okay, we now go to 2021. Okay, we get the gross profit margin. Same thing. Sales minus cost of sales. 68 million is the sales revenue. Cost of sales 25,772,000. So when we subtract 68 million minus 25,772,000, we get 42,228,000 divided by 68 million. We also get 0.621 again. Okay. Let's get our calculators. We confirm this. 42,228 divided by 68 million. So 0.621. Okay. So we can see the gross profit margin for this company has stayed constant. In 2021, it was 62.1%. In 2022, it's still the same 62.1%. So, colleagues, as investment analysts, what can we say about the performance of this company in terms of gross profit? What would you say? It's not growing, yes. It's not growing. Okay. Because remember, you might be asked to compare this to also analyze the growth of the company. So here it is not growing. Okay. Yes. Then another important thing, for example, if a company wants to increase its gross profit margin, what do you think should be done? There are two things that can be done to increase your gross profit margin. Okay. Either you increase your sales revenue. If you increase your sales revenue, okay, as compared to your cost of sales. If your sales revenue grows more than your cost of sales, it means you're going to have a higher gross profit. And then a higher gross profit means a higher gross profit margin. Apart from increasing sales revenue, a company can try to reduce its cost of sales. Okay. If you reduce the cost of sales, your gross profit is going to be large. A larger gross profit, a larger gross profit margin. Okay, colleagues. So remember that to increase for a company, to increase this gross profit margin, what they can do is either increase their sales, make more sales, all right, or reduce your cost of sales. You can try to do both or one of the two. Okay, it's easier said than done, but um, mathematically, that's how it, that's how you can increase your gross profit margin. If you increase your sales revenue or you reduce your cost of sales. The point is you want to have a bigger gross profit. Okay, so in order to have a bigger gross profit, more sales, less cost of uh, more sales revenue, less cost of sales. Then you have a bigger gross profit, which translates to a bigger gross profit margin. Okay, so in case if we saw a decline, let's say in 2021 it's higher, then in 2022 it's lower, then probably in 2022 it's either maybe cost of sales increased or sales revenue reduced. Any questions, colleagues? Because this is how you need to be speaking when you deal with these kind of questions. Any questions? Yes. So to increase your gross profit margin, either increase your sales revenue or reduce your cost of sales. And if you see the gross profit margin of a company has dropped, then it's either the sales revenue reduced or it's either the cost of sales increased. Okay. Yes. So the next profitability ratio is yes. So I'll give you also these notes also. All right. Next, we're going to get the operating profit margin. I won't say net operating profit margin. Okay. Operating profit, colleagues, this is your profit before interest and tax, or in other books, see as your earnings before interest and tax. That is your operating profit. Okay. So in this question, we're going to see here. We've been given profit before interest and tax. So this is our operating profit or earnings before interest and tax. This is the operating profit. So the operating profit margin, want to find out of our sales revenue, what percentage is operating profit, right? Or for every one kwacha we make in sales, how much do we make in operating profit? Okay, so operating profit margin is just your operating profit divided by the sales revenue. Okay, not net. Yes, operating profit margin is profit before interest and tax. So for 2022, the profit before interest and tax is 40,749,000. The revenue 74,521,000. Okay. When we divide 40,749 divided by 74,521, we get 0.198. Okay. So basically, for every one kwacha of revenue, 19 ngwe is operating profit. Okay. If in percentage form, convert this into a percentage, this is 19.8%. So percentage form, we can say 19.8% of the sales revenue is operating profit. Any questions before we go to 2021? Okay, operating profit margin, PBIT, 13,506,000 divided by 68 million. We get 0.199. All right. So basically, so they're almost the same. The other one was 0.198. This is 0.199. All right. So for every one kwacha of revenue, 19 ngwe, okay, is operating profit. In percentage form, 19.9% of our sales revenue is operating profit. So, colleagues, what can we comment about this? Mr. Sinkala, what would you say about this company? Okay, you can ask so that you get to the point you can express. Madam Mary? Okay, just like the gross profit, we can also see here the operating profit margin is also still stagnant. Okay, 19.8 and 19.9%. They're basically, if we round them off, both of them are 20%, basically. So there's still no change in this company. Okay, there's still less thing in terms of operating profit margin. Okay, we're still stagnant. One other thing I forgot to mention is also when you're doing this analysis, you can also look at the figures. Okay, you can also look at the figures and see, okay, in 2022, we had an operating profit of 14 million. In 2021, we had the operating profit of 13,506,000. Right. So it seems like our gross profit, our operating profit, and our sales revenue increased. Both of them increased. That's why we're having the same operating profit margin. But what we can see is in 2022, we made more operating profit versus 2021, despite the margins being different. Okay, we made more in 2022 versus 2021, despite the margins being different. Okay, so you can comment on the ratio, and also you can also comment on the figures. That's if you have a lot of time in the exam. You don't have a lot of time, just comment on the ratios. Okay, just comment on the ratios. Yes, any questions? Okay, then the next one, oh, to increase operating profit. In order to increase your operating profit, colleagues, you have to reduce operational expenses like advertising, traveling expenses, rent, selling and admin expenses, distribution expenses. Okay, those operating expenses, if you can reduce them, your operating profit will be big. Okay, but if those expenses cannot be reduced, then you find your operating profit will be low. All right, so that's one way you can increase this ratio. Reduce the operational expenses so that your operating profit can be more. Yes. So the next one is the net profit margin. Okay, net profit margin. As I said, out of your sales revenue, you want to find out what percentage is net profit. And out of every one kwacha you make in revenue, how much do you make in net profit? So the net profit margin is just your profit after tax and interest. That's your net profit. Once you deduct tax and interest, you get your net profit. So basically, it's your net profit over sales revenue. Okay. So in 2022, net profit 8,849,000. Sales revenue 74,521,000. All right. So if we divide 8,849,000 divided by 74,521,000, okay, we get 0.199. So for every one quarter we make in revenue, approximately 12 ngwe is net profit. Okay. If we convert this into percentage, 11.9% of the sales revenue is net profit, profit after interest and tax. Okay, we come to 2021. All right, net profit margin. Our net profit is 7,917,000. Sales revenue 68 million. So when we divide this, we get 0.116. So which is basically telling us for every one quarter we make in sales, approximately 12 ngwe is net profit. Okay. Convert this into percentage, 11.6% of the revenue is net profit. So even here, as I said, because if we round off these figures, 11.9 and 11.6. We're still coming back to 12. So in terms of net profit margin, again, this company is still stuck. Okay, it is still at the same level. So we can dig in deep and say, okay, if that's the case, we can now look in and say, okay, what is the actual net profit for 2022? 8,849,000. The net profit for 2021, 7,917,000. So you can comment and say, okay, at least in 2022, the net profit was higher than the one in 2021. Net profit and sales were higher in 2022 than the net profit and sales in 2021. Okay. It's just that the change in net profit and the change in sales is proportional. That's why we're still getting the same percentages. So you have to look in deep and start seeing the figures. Okay, colleagues? To analyze these things, don't just analyze those ratios, also go into the figures so that you can make more comments. Okay? Yes. Any questions? Okay. The next ratio is return on capital employed. Okay. How a company generates profits from its capital employed. Okay. Capital employed is funding for the running of the business to generate profit. Okay. But this is long-term funding. Okay. It's not short-term. It's long-term funding for the business to generate profit or to purchase assets, more assets. Okay. Or purchase assets or make investments. That is what capital employed is. So capital employed is equity and long-term debt. Okay. Equity and long-term debt. So if we go to our statement here, equity is here, shareholders funds. This is the equity. Also, we have our long-term debt. Okay, that's one way you can get your capital employed. Okay, or if we break it down to the accounting equation, because sometimes these some figures might not be given to you as plain as that. Okay, sometimes it cannot be given plain to you as that. Sometimes you might have to scout for yourself. So as we can see here, another way to find your capital employed is your total assets minus your current liabilities. Okay, remember, assets equals liabilities plus capital. All right. Assets here, we've got our current and non-current assets. So we'll still leave it here. Liabilities, we have our current liabilities plus the non-current liabilities. All right. Current liabilities plus non-current liabilities plus equity. So what I've done here in this formula, I've just taken our current liabilities here over this side. So assets minus current liabilities equals non-current liabilities, long-term liabilities plus equity. Colleagues, are we okay with this? Wonderful, sir. Madam Mary? Okay. So as I said, some of these things, okay, but if the question just tells you calculate ratios and you're not seeing uh, long-term liabilities and equity there, and it's hard to find capital employed, you can skip this ratio. Okay, but to earn more marks, the more ratios you put in, the better. So rate of capital employed, as we say, it's your operating profit, PBIT. You can also use your net profit. Yes. You will see some books say use net profit. They were indicated there in the question. Let me just go to it. Okay. Our long-term liabilities, madam, they were given here in the question here. Okay, so we don't need to do the assets minus current liabilities. We've got our equity here and long-term debt. Sure. I'm sharing, madam. Mr. Edward, are you able to see? Madam Mary, try to log in and log out. Try to log in and log out. Yes. So we start with 2022. Let's see what's the capital employed. Equity plus long-term liabilities, 39,900,000 plus long-term liabilities, 14 million. We get 53,900,000. Our numerator, we've got 14,700,000. Okay, okay. Our operating profit, 14,749,000. Okay. So once we divide 14,749,000 divided by 53,900,000, we get 0.27. Okay. So for every one kwacha invested in capital employed, the business makes 27 ingwe in profit. Okay. So rate of capital employed is just saying, okay, from this money that you're using to fund your business and run your business, how much are you getting back out of it? Okay. How much are you getting back of it? For 2021, all right, profit before interest, 30,506,000. Equity plus long-term liabilities, which is our capital employed, 52,587,000. When we divide these two, we get 0.26. So basically, for every one kwacha invested in capital employed, the business makes 26 ingwe in profit. So we did better by one ingwe in this case here. We've done better by one ingwe. Is that sufficient enough, Mr. Edward? If you are trying to invest in this company, one ingwe is too minimum. One ingwe is too minimum. So basically, like we're still almost on the same pace. Have you seen? So with these profitability ratios, colleagues, the more the better. Okay. So if let's say for every one kwacha invested in capital employed, if let's say we're making maybe a 15 way in profit, that would be better. You see, it's not that the money which we're investing into the business is bringing us returns. Okay. Then another profitability ratio, asset turnover, how a company generates revenue from its assets. Okay. So it's just basically the sales revenue over your total assets. Okay. So in the question, our assets even current assets. Okay, these are also other current assets, receivables, payables. Ah, no, payables is not an asset, sorry. Receivables, current assets. Let's see what other asset do we have here. Yes. We can also find our non-current assets. We haven't been given non-current assets here, colleagues, but do you know that we can also find our non-current assets? How do you think we can find our non-current assets? Because remember, assets, there's both current and non-current assets. So you want to find out from your total assets, non-current and current assets. So how we find our current non-current assets? We can still use this formula. Assets equals liabilities plus capital. Okay. Here, this we can still get our total assets. So what you need to do, you can add all your liabilities, long-term debt, current liabilities, payables, current liabilities, long-term debt, plus shareholders' funds. Once you add all of those together, you get your you get your total assets. Okay, colleagues. So there are two ways to do it. All right. And I think this will be the best way because this way it's going to give us the total value of our assets. Okay. Give us the total value of our assets. So let's just add up. Let's add up, colleagues. So shareholders funds, which is equity, plus long-term debt, plus current liabilities, plus payables. Or even this dividends payable, this is a liability also. So we can add this. Let's add this together, colleagues. What's so we get the total value of our assets. 48 plus 39.9 plus 14 plus 95 plus 8 pin. You know, with a calculator. Anyone with a calculator? Mr. Sinkala, do you have a calculator? Madam Mary? Plus 39.9 plus 39.9 plus 14,000. 76,200. Okay. That's how. Okay. Then for this year, 2021, dividends payable, shareholders' funds, long term debt, current liabilities. Oh, 8,600. 64,287. Okay. Okay, just go through it one more time. Yes, 62,287. Yes. So we come, let me get these numbers down first. 76,200 and 66 or 64 to 87. 2021. Mr. Mr. Edward or Madam Mary, it's 66 or 64? Madam Mary, I think you also said 64, right? Okay. So here, let me just make an adjustment for 2022. We found 76,000. Are these in millions? Just hold on. Oh, yes. So it's millions. Okay. So it's 76 million since there are three zeros on top. So, yes. So it's 76 million 200,000. So we divide our sales revenue for 2022 was 74,521,000. So when we divide 74,521 by 76,200,000, what do we get? 74,521 divided by 76,200,000. 0.97. So for every one kwacha invested in assets, the business makes 97 in way in sales revenue, which is very good, which is fantastic. We come to 2021. Okay. Total, here we got 64 million. 64,287,000. Okay. Yeah, so 68 million divided by 64,287,000. Okay. So for every one kwacha invested in assets, the company makes one kwacha 5 ngwe in sales revenue. So here in 2021, we can say they are utilizing their assets well because the assets are bringing them a high amount of sales. Any questions? So in 2021, the company was utilizing its assets more efficiently to make sales. Okay. In 2021, the company was utilizing its assets to make sales, utilizing its assets more to make sales as compared to 2022. Yes. So there we are done on the profitability ratios. Any questions before we move to liquidity ratios? I'll send the workings, yes, most definitely, so that mhm, you can apply it to the assignments you did. Okay. Okay. Next, liquidity ratios, the ability of a company to pay expenses and short-term debts when they fall due. Okay, so with the liquidity ratios, as I said, you've got the current ratio, the this one, what was this one called? The quick ratio, and we also add in the cash ratio. Let's see if we have a balance for cash here. Do we have a balance for cash? No. Okay, if you are given a balance for cash, you can also do the cash ratio. So with these liquidity ratios, you want to see, can I cover my current liabilities with my current assets? If you can cover your current liabilities with your current assets, you're in a good position. When expenses or liabilities fall due, no, when actually, let me say, when liabilities fall due, you'll be able to pay them off and remain with some change, which we call the working capital. Okay, current assets minus current liability, you get working capital. Then working capital, that is the one that is used for the day-to-day running of the business. Okay, after taking out your current liabilities, that working capital is now for the day-to-day running of the business. So for current ratio, it's just current assets over current liabilities. Okay, current assets over current liabilities. If your current ratio is greater than one, you're in a good position. It means your current assets exceed your current liabilities. If your current ratio is less than one, then you are facing liquidity problems. It means you cannot cover your current liabilities with your current assets. You need to outsource some more money to cover them. And then now, the other problem falls in is because now, after you fail to cover your current liabilities, then you've borrowed to cover them. Now, what about for the running of the business? Obviously, there will be problems there. You won't have working capital for the business. So, for this company, 2022 current assets, the current assets, I just added these ones: current assets, receivables. Okay, current assets, receivables, and inventory. Okay, these are our current assets. So sometimes they'll bring it like this. It's up to you to remember, okay, what is a current asset? What is a current liability? So current assets, 20,000 plus receivables, 15,500 plus inventory, 3,000. Okay. Current assets on top. Then current liabilities, again, you come back here again. Current liabilities, okay, you've got dividends payable. You've got these current liabilities and you've got your payables. Okay. Payables, current liabilities, and the dividends payable. Those form your current liabilities. Okay. So you must also remember what your current liabilities are. Okay. So when we add the current assets for 2022, 38,000, 38,500,000. The current liabilities, 22,300,000. So when we divide, we have a current ratio of 1.726, which is a good thing. It means this company can cover all its current liabilities with its current assets, and has some working capital for the day-to-day running of the business. Okay. In 2021, still the same current assets. You just add your current assets, receivables. Okay. Let me just come here. I already added there. I never just wrote the workings. Okay, but you add current assets, receivables. Okay. Why is it okay? Let me mark them out. Yes, for the current assets, I'm marking them in green. Okay, current assets, this, receivables, and inventory. You add this. Then for your current liabilities, you just add dividends payable, current liabilities, and payables. That's how you get your current liabilities. So here in this question for 2021, we get a current ratio of 1.994, which is almost 2. If we round it off, assume if we round also the other one off, it will be 2. So we can just see a small decline. That's a minor decline. Okay. A minor decline. But overall, the company is in a good position. It can cover its current assets, I mean its current liabilities with its current assets. Okay, they're in a good liquidity position.